This is Barry Zalma speaking for Claim School Incorporated's blog, Zalma on Insurance. Today we're going to speak about why insureds must negotiate the terms of an insurance contract before they enter into litigation with their insurer, and why litigation is an improper method to negotiate insurance coverage, especially when the insureds are billion-dollar companies who are quite capable of protecting themselves and negotiating the terms and conditions of an insurance contract. Plaintiffs attempted to secure insurance coverage for an action currently pending in federal court. The plaintiffs looked to two towers of directors and officers, or D&O insurance, to provide that coverage, naming a dozen or more individual insurers in the process. The problems faced by the insurers were: 1, a provision in the earlier tower of insurance, dubbed the, quote, no action, close quote, clause, commands that no action may be filed against the insurer until the insured's payment obligations are finally determined. 2, plaintiffs attempted to convince the court that the need to enable swift litigation against insurers outweighed the need to enforce the contracts as written. 3, the prior acts exclusion found in the latter tower policies, and 4, the underlying litigation centers on alleged wrongs that occurred too early to be eligible for coverage under the latter tower. In Insureds USA LLC and Guy Vanderhagen versus Great American Insurance Company et al., the Superior Court of Delaware on May 9, 2024, explained the way that Delaware interprets insurance contracts. The insurers are two towers of multiple insurers who are named as defendants. The underlying litigation are only tangentially relevant to the coverage dispute. It was brought by Pentacon BV and Baltese NV, together the investors, to recover sums that plaintiffs and plaintiffs' affiliates who are not insured under the two towers at issue here allegedly stole through fraud. The heart of the allegations are that plaintiffs and their affiliates undersold the investors on the value of the investors' shares in Insureds and Insureds' parent company, Insureds Energy NV. Plaintiffs and their affiliates bought out the investors' interest in Insureds and Insureds Energy for $105 million. Just a few months later, plaintiffs sold Insureds to a third party for $1.4 billion. The investors complained that they did not get their fair share of that payday. Now, the 2021 to 2022 tower was started by the principal insurer, Great American, which was followed by the other insurer's policy, in which stated, quote, with respect to any liability coverage part, no action shall be taken against the insurer unless, as a condition precedent thereto, there has been full compliance with all the terms of the policy, and until the insured's obligation to pay has been finally determined by an adjudication against the insured or by written agreement of the insured claimant and the insurer, close quote. The 2023 to 2024 tower provided that the insurers had a policy period of February 4, 2023 to 2024, and in this time frame, Bridgeway Insurance issued the primary policy, and several other insurers together the 2023-2024 excess insurers, and together with Bridgeway, the 2023-2024 insurers each issued excess policies in an ascending order. After the applicable retention, each of the insurers had a $2.5 million limit. Each of the 2023-2024 tower policies had a provision excluding coverage for claims arising out of the wrongful acts that first occurred before November 18, 2021. RSUI's first layer excess policy reflects a fairly representative sample stating, quote, "The insurer shall not be liable to make any payment for loss in connection with any claim made against any insured that arises out of, is based upon or attributable to, directly or indirectly, in whole or in part, any actual or wrongful acts which first occurred prior to November 18, 2021. The appellate court noted that Delaware courts review insurance contracts to assess the parties' intent, quote, as expressed through their contractual language, close quote. Like any contract, when an insurance contract's terms are reasonable, susceptible to but one meaning, and are thus unambiguous, Delaware courts will apply that meaning. Finding that the no-action clause precludes the litigation against the 2021 to 2022 tower, and that plaintiffs cannot use the litigation to reopen negotiations with the insurers, Great American, joined by Markel and other insurers, argued that the plain language of the no-action clause blocked plaintiffs' ability to bring this coverage dispute before the underlying litigation concludes. Delaware courts are exceptionally inclined to hold sophisticated parties to their bargains. For that reason, the court refused to disregard the no-action clause as the insureds had hoped. The court was fully confident that the representatives of this billion-dollar company were well equipped to understand the policy language and negotiate any necessary changes. The court enforced the no-action clause as it was written. That prohibition will be lifted when plaintiffs satisfy the two conditions contained in the no-action clause. Until then, the 2021-2022 insurers' motions to dismiss must be and was granted. Then the prior acts exclusion was found to preclude coverage under the 2023-2024 tower. This analysis was even clearer with respect to the unavailability of coverage for the underlying litigation. Even if the court were to accept that plaintiffs met their burden to establish coverage, the 2023-2024 insurers successfully refuted that coverage with the prior acts exclusion, and therefore the 2023-2024 insurers' motion to dismiss must be and was granted, and the plaintiff's policies simply do not support the plaintiff's current suit. In one set of policies, plaintiff agreed not to sue their insurers until the occurrence of a particular event that has yet to occur. In the other set of policies, plaintiffs waived coverage for pre-existing wrongs, such as the underlying litigation. Accordingly, the motions to dismiss were granted by the court. In my opinion, insurance contracts with multiple towers of insurance coverage, with multiple insurers taking on the risk of loss in excess of the underlying insurance coverages, where in this case the layers contained multiple insurance policies waiting for each layer to pay out its limit before the next in the tower has to pay. Here the contract language limited the coverage in ways that upset the insureds, who tried to rewrite the policies to provide coverage they did not buy. The court refused to change the conditions of the policy because they were clear and unambiguous, and negotiated at arm's length by sophisticated insurers and sophisticated corporate insureds. This video was adapted from my blog, Zalma on Insurance, which is available free to anyone who clicks on the URL zalma.com/blog. If you subscribe to the blog, you will receive notice of every blog posting, usually 5, sometimes 6 a week, and you'll also get access to the more than 4,800 blog postings. If you're interested in further detail about insurance, insurance claims, insurance fraud, and insurance law, please consider subscribing for a very small fee to my Substack publication. Thank you for your attention.